to the outlook for 2026 coming in from Axis Bank. Neelkanth Mishra, who's the chief economist at Axis Bank and head of global research, Axis Capital, joins in now. Neelkanth, always a pleasure to welcome you on NDTV Profit and about your views coming in on the market and economy. What are the key highlights in this particular report and the view on the economy for the next year?
See, the main point that we are raising is in the report is that there is a significant amount of slack in the economy. This is a discussion which kind of faded out post-COVID because India is the only large economy in the world where the workforce is expanding. And given the fact that we are 5 to 11% below our pre-pandemic path, it suggests that there is a significant amount of labor market slack. And this is showing up in various ways. You know, real wage growth is weak and low-end consumption, except for periods when there is a stimulus, there is an issue. So there is slack in the economy, which means that we can run the economy faster than trend growth without having an immediate pressure of inflation. So this is the most important point that we are making. We are also bringing into discussion something I've been saying for several months, but re-emphasizing that in FY25, we had fiscal and monetary tightening happening at the same time. So the fact that the fiscal headwinds faded in FY26, this fiscal year, and monetary was eased, but it is not yet latched on. So basically, the credit growth is yet to pick up. In FY27, the fiscal headwinds will be a lot more moderate. We are expecting 20 basis points. Let's see what the government does in the budget. But the monetary easing can actually provide tailwinds. So growth can be above trend. And so we are forecasting a 7.5% real GDP growth.
Right. So that's the word coming in from your outlook, and acceleration in growth, 7.5%. But Neelkanth, we have seen enough of the concerns coming in from the deflationary trends at the current moment, inflation playing a spoil spot. Where are you on the debate on growth versus inflation?
Exactly. So long as there is slack in the economy, see, and this is something that policymakers have also now begun to latch on to, that there's no need to respond just to the growth rates, meaning that if your trend growth is, say, 7, so, some people had slipped down to 6% also, but I think over the past 2-3 years, it has reached up to 6.5, some are at 6.8, 6.9. I think it is above 7. But anyway, this is actually quite a bit of guesswork. But even if, say, trend growth is 7 and you're, say, running at 7.5, should monetary policy start to tighten? But I think very correctly, policymakers are now questioning what is the slack in the economy. So suppose there is a 5% slack in the economy and trend growth is 7%. So you can run the economy at 8% for 5 years before the slack is closed, which is when sticky inflationary pressures start to come up. And given that we are likely to see another year of fiscal consolidation, meaning that 4.4 in our forecast is 4.2 in FY27. It suggests that monetary policy can be slightly more relaxed, given that the fiscal is still being curtailed. So, given all this, I don't think we will reach a level of inflation where policy needs to be tightened. Will inflation pick up from here is actually a much bigger question currently. So there are people thinking that the deflator next year could be again 1.5%, which I think is not appropriate. We will see. So like we saw in the month of November, that inflation is starting to pick up, starting to normalize. If you look at food inflation versus core inflation, it is it tends to be in a band, and it is at absolutely the lowest level of that band. So it is going to rise from here. But we don't expect core inflation to really accelerate till the time that the labor market slack is full, which is actually some time away.
All right. Rupee at the lowest level, Neelkanth Mishra. And of course, you said that monetary policy easing is done for now. The transmission will take effect from the next year with a lag effect. What is your view on the benefits on the economy with the transmission of monetary policy and also the stance of the RBI for the next year?
Great question. So monetary policy transmission occurs through several channels. Several of them are not very effective in India. So, for example, the exchange rate channel is not very effective. The asset price channel is not very effective. The two channels that are effective are the rates channel, meaning that if your interest rates are 1% point lower, the likelihood of someone borrowing goes up. But that too is not a particularly effective channel, because if the effective rate is say 10, 10.5, 11%, for many of the NBFCs even 18, 20%, a 0.5%, 1% change in interest rates does not really drive a lot of credit growth. The most potent channel in India is the credit risk channel. That is, are lenders and borrowers willing to take risk? So for lenders, I think the decisive message from the central bank has been helpful in starting to take on some credit risk. But at the same time, if the economic momentum is decelerating, it is very hard for the execution teams to start lending when they know that incomes are still shrinking or at least not growing as fast as they should. Which is why this GST cut, I think, has helped build that confidence, bring in that positive momentum. And therefore, the likelihood that credit growth now starts to pick up is much better. On what they need to do, so there are several points of interest. The first is, as someone who advises the government on the duration of debt, so the weighted average maturity, the average duration of government loans now is 13.2 years on the outstanding stock. And it was as high as 21 years in the last 1.5 years in terms of incremental issuance. That is also distortionary. So we need to bring that duration down to more reasonable levels. Treasury bill issuance had slowed sharply in the last 1.5 years because as the government transitioned to the just-in-time transfers to state governments, the cash balance that it held with the RBI was going up, and therefore they reduced the T-bill issuance. If you shift, say, 2.5-3 trillion rupees, 2.5-3 lakh crores from bonds to bills, that automatically brings down the 10-year bond yields, and at least the yield curve starts to become less steep. I think they also need to start signaling, or at least start doing more work around a measurement of slack in the economy, because the markets currently are pricing in that after 1.5-2 years, the rate hikes will restart. So remember that everyone is anchored to inflation rebounding. We are not used to a situation where the government is persistently consolidating fiscally, and therefore, and there is a lot of slack in the economy. So therefore, I think putting out research, giving comfort that the rates, that there is enough slack in the economy, is something that, of course, it's not just the RBI, but I think the markets as a whole will have to start getting used to it. And when that happens, I think the term premia can start to moderate, and that itself will be as effective as several rate cuts.
Right. So, Neelkanth, finally, the economy is slackening. What needs to be done to boost it, especially with rupee depreciating?
So, you see, on the currency side, this false sense of bravado that a strong currency means a strong economy is something that we have to let go of. Because the currency is just, a kind of a balancing factor. So if your balance of payments is where it is, and even if temporarily we have a problem that, and it's a temporary problem, that so much of FDI repatriation is happening. See, we used to see $20-25 billion of FDI repatriation till about 4-5 years back. That number is now $45 billion. So we have a $20-25 billion extra outflow happening because the markets are hard. Venture capital, private equity investments, which had come in 5-10 years back, are now going out. But as they get exits, they're actually becoming much more willing to bring money back as well. So we are starting to see, for example, in the financial services space, quite a bit of direct investment starting to happen. It's of great strategic interest. So all of those things will happen. But temporarily, we have a balance of payments issue, which I think the RBI shouldn't try to hold a level. I think their focus should be on just curtailing volatility, because volatility can be damaging. The real effective exchange rate, which is the final arbiter of manufacturing competitiveness or the currency's contribution to manufacturing competitiveness, is already near 10-year lows. So I think the weakness is now kind of sufficient and therefore doesn't really need to weaken significantly from here. In the next 3 to 5 years, I fear that there will be global competitive currency debasement, meaning that every single country will try to weaken its currency. And even the US, given that most of the measures they took are becoming ineffective in terms of triggering local manufacturing, there's some of them, like say, for example, in agricultural farm equipment, if you put a 50% steel duty, it is not surprising that farm equipment manufacturers are struggling and therefore farmers are struggling. So as they figure out that these are serious issues, I think they'll have to look at new options. And frankly, the easiest option for most countries is to devalue their currency. So if the US starts to debase its currency, the Chinese real effective exchange rate is falling. From a strategic perspective, a slightly weaker rupee is actually not that big an issue.
All right. So currency depreciation, not big an issue, and many more countries may go for further debasement of currency in the next few years. Neelkanth Mishra, always a pleasure to take your views and perspective